Today we are looking at 5 undervalued industrial REITs, which are my favorite type of REITs as these will always be needed. As we can see, industrial REITs essentially have properties like warehouses and distribution centers which are always in demand by the likes of Amazon, Home Depot and Walmart amongst many other big known companies. Now, as always, we are going to take a look at 5 of them in detail. We're going to look at their historical performance. We're going to take a look at their dividend safety, look at their financial metrics, and we will run them through our valuation model to get to the intrinsic value as well as the acceptable buy price given that investor margin of safety, and see what Wall Street are forecasting for the next 12 months. And if you stick around to the end of the episode, we are also going to take a look at essentially a new real estate ETF to cover all of these within if you do not like to pick individual stocks. And we're going to start off with Americold Realty Trust. Now, every single one of these REITs that we are taking a look at today have a nice starting yield and double-digit upside. So not only are they undervalued, there is a nice yield to go, and Wall Street do see some very long-term growth as well as short-term in the next 12 months. So the first one, Americold Realty Trust. Now, over the last year, it is down around 11%. We can see it pretty much trading at its 52-week low with a starting forward yield of 3.55%, a P to FFO of 21.95, and as we can see, over the last 5 years, it is down around 20%. So let's take a look. Dividend safety score, we see a score here of 70. It is safe. Market cap 7 billion. It is a mid-cap company. Now, in terms of the last recession, well, the recessionary metrics show there was no dividend paid during this period. However, they had negative 12.5% recession sales, which was the average of the S&P during that time. So let's move on to the dividend growth. Now, they haven't increased their dividend since 2021. However, on average, over the last 5 years, it has been increasing by 5%. Over the last 10 years, up 24% on average year on year, which is very positive if you are a dividend growth investor. So we can see, whilst they have maintained that dividend for a few years, we can see they have been paying a dividend for the last 7 years without a reduction. As always, we'll take a look at dividend yield theory, which states a company is undervalued when the current yield sits above the 5-year average. 3.56 versus 2.69, so we have our first sign here. And today, for cold, we have a double sign of undervaluation with the forward P to FFO 18.1 below the 5-year average. And when we compare it to the real estate sector P to FFO, it does sit lower at 13.7. Now, do bear in mind, we're not looking at any of these models in isolation, and we'll conclude towards the end of the episode. Now, always for REITs, let's focus on the adjusted funds from operation payout, given the free cash flow is more volatile. We want to see, now this is a rule that we have for the industry specific for industrials below 75%. And whilst it has been above that in 21 to 22, it hasn't been massively above the 75% threshold. And in more positive news, 69% in 2023, going lower to 64% expected in 2024. So I would like to see this year a dividend increase to this stock that does look very positive so far. Now, adjusted funds from operation per share, we do see it very inconsistent. In fact, over the long term, it has decreased. But on a more positive note, 2023 to 2024, we are expecting an increase to $1.37. It is positive to note on the adjusted funds from operation that there was double-digit growth in 2023, and in 2024 it is expected to grow by around 8%. Whilst we do note 4 years from this period we can see negative growth, in more recent times it is expected to look much better. Sales growth, now for REITs, we want to see steady moderate growth of 5 to 10%, and we can see 2022 fit that at the 7% level. 2023, unfortunately, there was a negative 8% to their top line, and that is factored in whilst we saw that share price drop over the last 12 months. Now, numerically speaking, they have increased their top line from 1.49 billion to 2.67, and as we always say, typical with REITs, they do essentially issue equity to fund property acquisitions, so your position as a shareholder will be diluted over the longer term, going from 70 million to 276. As we go along, these industrial REITs which are undervalued today, do take a look as some of them will essentially dilute your position at a much faster rate. Now, ROIC, What we're looking for here is 3 to 5%. That is to give us faith that management are able to effectively allocate their capital. Now we can see the last 3 years it has been pretty low at 2%. Nice to note, before then we did see around 3 to 8%, so I would like to see management bring this up to at least a minimum of 3%, and they aren't too far off it over the last few years. Operating margin, personally, I want to see 12% on this metric. We can see they have struggled over the longer term. 6% in 2023, something just to consider. And all of these different metrics that we look at, those that we do indicate need to be slightly better, will be factored in when we take a look at our margin of safety shortly. Now, the net debt to EBITDA, the earnings before the interest, tax, depreciation, amortization, this correlates to both dividend safety and balance sheet strength. What we want to see for industrial REITs is below 5. Now, we can see 5.6 in 2023. It is expected to go lower in 2024 to 5.19. Whilst this isn't below the 5 that we want to see, still showing progress that it is coming to that level that we see as a maximum. And remember, this is the number of years that it would take the company to pay off all of their debt net of cash on hand. Now, there are some metrics that we have gone for this company that we would say are something to bear in mind, and it is something that we can factor in when we do look at our margin of safety for this company. As always, if you do enjoy the content, values being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. As always, when we do deep dives on companies, we do take a look at every single one of these models. For today's episode, let's jump straight through it to get to the intrinsic value, which we arrive at $30.90. Now, in terms of the current price, we can see that at just under $25. As always, margin of safety, we start off with 10%, and we use that if it meets those 3 important criteria. Remember, wide moat, strong financial metrics, and good forward-looking data. If you believe that with this company, well, your MOS at 10% would be a buy up to $28. If we go to 15%, up to $26.27. At 20%, it is essentially 1 cent shy. So we do believe right now that Cold has a 20% margin of safety level based on our estimates and judgments. And in terms of Wall Street, well, they give this a very strong buy indicator. They have a price target of just under $33 with upside of 32%. But as always, we are keen to hear your thoughts in the comments below, whether or not you do believe this is a strong undervalued company, whether it's one you're adding to your portfolio or on your watch list as we go along the other industrial REITs we're analysing today. Also, just to let you know, we have released our latest free weekly article. If you want to gain access to this as well as all the other articles that we have, all completely free, do click on that pinned comment below where you will gain instant access. Now, the second industrial REIT that we are reviewing today, as you can see, is Prologis. Now, this REIT, for those that didn't know, is the largest US REIT and the only REIT with an A credit rating. It is up 8% over the last 12 months. Over the last 10 years, up 207%. Bear in mind, these metrics don't include those dividends reinvested, and we see all-time highs around that $170 level. So currently it's trading in the mid to upper end of the 52-week range with a yield of over 3% and a P to FFO forward-looking of 23.13. Now, dividend safety score we see here 61. It does look to be safe. Market cap 118 billion, a mega cap company. Now, in terms of the key metrics, well, in the last recession, they did in fact cut the dividend. They had below average growth, and they also significantly trailed the S&P 500. As we can see, the S&P returned negative 55%. Dividend growth, however, over the last year, or in fact just over the last month, they increased it by double-digit 10%. We love to see that. And over the last 5 years, 13%, very positive when we see that over a longer term. But do note, over the last 20 years, however, it has been at 0%. And as we can see here, they did cut that dividend quite a few times over the last 20 years. But nonetheless, they have been increasing those dividends for the last 10 years, with 12 years paying a dividend without a reduction. Now, in terms of dividend yield theory, as we can see, we have that sign of undervaluation on the yield, 3.05, well above the 5-year average of 2.5. But we do note the forward PE sits fairly in line with the 5-year average and significantly higher than real estate sector P to AFFO. In terms of the adjusted funds from operation payout, now 2023 was below the 75%. Just bear in mind, 2024 it is expected to come up to 87%. It isn't something that I like to see, but given that this has only happened once above the threshold in 2014, I do like to give them the benefit of the doubt that this is just a one-off, but something again to keep an eye on and factor into our MOS level. Now, adjusted funds from operation, nice to note the large increase over the last 10 years, but do factor in 2024 it is expected to drop down to 443. And when we take a look at it percentage-wise, it has been on a very strong run from 2014 to 2022, nearly double-digit growth to their adjusted FFO every single year. But we do note 2023 and 2024 it is expected to be negative. On the other hand, we do see that steady to moderate growth to their top line over the last 10 years, pretty significantly nearly every year. The last 2 years, strong double-digit growth to their top line. And numerically, we can see they have grown their top line rapidly from under 2 billion in 2014 to over 8 billion in 2023. Again, shares outstanding, we do know they nearly doubled that shares outstanding over the period. But again, this does mean different things to different investors. Some investors, they don't factor this in. It doesn't really bother them. Something I would just say just to consider and look at benchmarking to others in the similar industry that you can do in today's episode, given that we're looking at this industrial sector. ROIC, it does look very nice given that it has increased from the lows of 2% in 2014-15 to around 3 to 4% over the more recent period. So that is something that I would personally be satisfied as an investor, or if you were an essential potential investor. Now, operating margin, we do like to note the operational efficiency. It has increased over the longer term. 41% over the last 2 years is very attractive as well for an investor. And the net debt to EBITDA, now whilst we do see it above the fact of the 5 over the longer term, it is nice to note 2024 they're expecting to bring this down. So the company overall is moving in the right direction. We can note that given it was 6.14 and has steadily come down nearly every single year over the last 10 years. Now, what does this essentially mean to the valuation? Let's get to the intrinsic value. And don't forget, you can grab a copy of the valuation model to get to the intrinsic value, as well as the acceptable buy price of companies in your own portfolio on your watch list by clicking on the pinned comment below. Now, a margin of safety of 10%, it is a buy up to $140 if you believe that is sufficient. At 15%, up to $132. And at 20%, it is essentially around $1 shy. So I would be comfortable in saying that this has around a 20% margin of safety based on the estimates and judgments today. In terms of Wall Street, well, they see this as 18% upside. They have a price target of $149. And do bear in mind, with these companies, you are locking in a very nice starting yield. However, if the share price does go up, the yield goes lower. So factor that in as well. Something just to consider if you are very bullish on a particular stock or REIT. The next undervalued REIT that has some very nice upside is Rexford Industrial Realty. Now, this is down around 14% over the last year, trading in the mid to lower end of the 52-week range, with a 3.3% starting yield and a P to FFO forward of below 22. Now, we can see over the last 10 years, you would be up 245%, and it has hit its all-time highs around $81 twice over the last few years. Now, in terms of their dividend safety, very safe score, 81. I do see this as a potential under-the-radar REIT that people may not have heard of. Market cap, just under 11 billion. It is a large cap company, and we don't have any information for the recessionary data, so let's move on to dividend growth. Absolutely incredible, 9.9% last year, or in fact last month I should say, 19% over the last 5 years, 22% over the last 10 years. This is a very strong REIT to consider if it isn't one you already have in the portfolio. Over the last 10 years, they have been as well increasing those dividends. Now, dividend yield theory, we can see that double sign of undervaluation. The yield is significantly higher than the 5-year average, and the forward P to FFO is lower than the 5-year average, although it does look very high at 39.4, and also factor in that the sector P to FFO is much lower. Now, in terms of Rexford Industrial Realty, their adjusted FFO below 90% again is what we're looking as a blanket rule. It really does come down to whether or not you want to be industry specific, even within the real estate investment sector. 88% over the last year, 88% expected again in 2024. No real reasons to worry in my opinion. It does look safe based on this information, but dividend safety does also correlate to the net debt to EBITDA that we'll look at shortly. Adjusted FFO as well, pretty much other than 2014 to 15 where it did drop, it has been consistently increasing year on year. 2024 expected more of the same to $1.90, and we can see when we look at that percentage wise, it does look very strong and healthy year on year. On top of that, even though the sales has been decreasing over the last 10 years, 26% in the more recent year looking very healthy, and numerically they have increased very rapidly from 66 million to under 800 million. Although it is important to factor in, they have been diluting your position as a shareholder very rapidly. It is up more than 6 times since 2014. In terms of the ROIC, now it's nice to note that it has been increasing. Yes, very poor in 2014 to 15, but we do see 2023 at 3%, and I would like to see this consistently over the next few years at a minimum. Operating margin, well, again, another sign here in terms of this REIT with operational efficiency, increasing it year on year. Lots of positive metrics to see, but one of the most important is the net debt to EBITDA, and we can see that has been decreasing. 4.07 in 2023, 3.49 expected in 2024. This could essentially be one of the best REITs that you may not have heard of to consider for your portfolio. Let me know below though, this may be one that you do already have or has been on your radar for quite some time. Now, in terms of the valuation, which is always important just because it fits the metrics for your portfolio, valuation is very key to buy at the right price. Now, margin of safety, 10% shows a buy up to $53, 15% up to $49.91, and 20% not quite there yet. So at a 15% MOS level, Wall Street give this a buy due to the fact that they have upside of 22% and their price target just under $60. Now, in my opinion, this does look like a very strong REIT. Do let me know if you want to do an episode dedicated to this REIT. But you're getting between 15 to 20% MOS level, upside of 22%. The starting yield is favourable as well, around that 3% level. And we can see the metrics do look very strong, and they have been increasing over the last 10 years. We then move on to what is one of the most requested REITs to review on this channel. It is Stag Industrial. Now, it is up 15% over the last year, and we can see over the last 10 years, whilst it is up 59%, it is quite some way away from the $48 all-time high we saw at the back end of 2021. Nonetheless, it does trade at the upper end of the 52-week range with a yield of just under 4% and a P to FFO of just under 16. Dividend safety, 60 borderline safe. We can touch upon that shortly. Market cap, just under $7 billion. It is a mid-cap company. Now, in terms of the recessionary metrics, the only one we do have available to us is that there was average growth during the 07-09 recession. Dividend growth, it is one area, in my opinion, that Stag Industrial does lack. 0.7% just over the last 2 months, 1% over the last 5 years, and over the last 10 years, 2%. So bear in mind, as I always say, we advocate massively on this channel to get at least 4% increase in your dividends, even your salary, even in your other income producing assets, just to keep up in line with inflation. Stag Industrial have been increasing those dividends over the last 12 years. Now, in terms of dividend yield theory, we do here see a sign of overvaluation with the yield below the 5-year average and the forward PTFO slightly above that 17.5. And again, we do note they are above the real estate of 13.7. Now, in terms of the adjusted FFO, below 75% for industrials, we do see it has been decreasing, which is positive to note, which could be an indicator that we may see a nicer increase rather than below 1%, with 73% expected again in 2024. In terms of the AFFO per share, well, we do see it has increased. Very inconsistent though. Nice to note, 2024 we are expecting an increase from the $2 in 2023. And we can see, whilst it isn't the most consistent over the last 3 years, it has returned some very strong growth. 2024, whilst growth 4% is lower than the last 3 years. Sales growth, whilst it is around that 5 to 10% level in 2023, it has been decreasing from the highs we saw of 30% in 2014. So numerically, again, a lot of people do like to see the numbers. It has grown actually quite rapidly from 174 million to 708. Again, on top of that, you shouldn't come as any surprise now on this channel as we do review REITs a lot. They have increased those shares outstanding quite significantly. ROIC, now this is very important to note. It has been not just increasing, but we do see 4%, which is the highest that we have seen on this channel in terms of looking at those REITs today. 4% looking very healthy. In fact, 3% consistently over the last 5 years. Always good to see around a 3 to 5% level for REITs on the ROIC metric. Operating efficiency, again, 14% up to 34, a very large increase. So that is very healthy, and hopefully they can, at a bare minimum, just continue around the mid-30 mark. And when we take a look at the net EBITDA, which does drive that dividend safety score above that we saw at borderline safe, it does straddle around that 5 over the last 10 years. Nice to note it's below that in 2023. 2024 it is expected to come lower to 4.65, which this signals to me the company is looking at operating more effectively. We're seeing them lower down their EBITDA rate in terms of their net debt to EBITDA figures, as well as the fact that the payout is starting to come down lower. So I would like to see them increase those dividends at a much larger rate than below 1%. Now again, let's get to the valuation, as this is important if this is one of those REITs that you do want to add to your portfolio. And we can see $41.55 for the intrinsic value. Margin of safety level then 10%, a buy up to $37.40, so it isn't too far off. So Stag Industrial we see at a 10% MOS level, and remember it really does come down to what MOS level you are happy with as an investor, depending on your criteria and investment thesis. In terms of Wall Street, well, they do see around a 10% upside over the next 12 months. So again, remember it comes down to whether or not this REIT does fit your portfolio, but it does look to be undervalued by around 10% with 10% upside over the 12-month period. We then move on to FR, First Industrial Realty Trust. Now this is up around 1% over the last year, and we can see over the last 10 years up 169%, a little bit away from its all-time highs of $66, and we do know that it is trading in the mid to upper end of the 52-week range, with a yield below 3% and a P to FFO below 19, or in fact below 20. In terms of dividend safety score, we don't have a score just yet. We do in fact see a market cap of just under $7 billion. It is a mid-cap company. Nice to know, over the last full year, 8% increase to the dividend. Over the last 5 years, 8% again. But do know, over the last 20 years, on average, it has decreased by 4%, as we do see that very large dividend cut in 2007 as well as 2008. In terms of their sales growth, we can see over the last 10 years, it has been very inconsistent. Some years single digit, and we do see the last 2 years double digit, but still it is within the 5 to 10% over the majority of the last 10 years. And numerically, we can see it has gone up from 319 million to 540 in 2022, 604 expected in the full recent year. In terms of shares outstanding, well, probably the one company or one REIT that we have reviewed today that doesn't dilute your position at a quick rate in comparison to the others. When we take a look at the ROIC, nice to know, actually at the higher end of what we see at the 3 to 5% level. In fact, since 2016, it has been 5%, which is very nice to see and attractive and healthy as a potential investor. Operating margin, not only has it had operational efficiency where it has been increasing, but low 40% or even at 40% over the last 2 years is very, very strong for this REIT. Now, in terms of the net debt to EBITDA, we want to see around that 5 level or lower. Now, we do know it has been decreasing from the highs we saw in 2014, 2015. 5.31 in 2023, not the greatest, but also not the worst. Positive to note is coming down below 5 in 2024 at 4.89. Now, in terms of the valuation of FR, let's get to that intrinsic value. And for today's episode, it's coming to around $62. Now, with the current price of $51.41, there is some nice margin of safety at 10% up to $56, at 50% up to $53. But we can see for today's episode, it's not quite at the 20% level. But for FR, based on these estimates and judgments, the MOS level sits between 15 to 20%. In terms of Wall Street, well, their forecast is around $58 over the next 12 months, so they see upside of 12%, again indicating they believe this to be a buy, but it does really come down to the MOS level you are looking for, maybe not just with these companies, but maybe as the sector as a whole, or maybe with the economic situation, you do want to have a higher MOS level. As always, let me know your thoughts in the comments below, whether or not you are adding to any of these 5 undervalued REITs with some nice upside as well. Now, as we mentioned at the beginning of the episode, we were going to take a quick look at a REIT ETF for those that essentially want broad exposure. Now, this is one, as we can see, with an expense ratio of 0.14%. Now, what are this essentially targeted at? These are for people who essentially want a broad exposure to REITs from across the world, and they invest in real estate and they trade like stocks. If you want to essentially diversify your portfolio, seek income, and not pick stocks and worry about whether or not there are any news or issues with stocks individually, and have some peace of mind. Now, expense ratio isn't too bad as well, as we mentioned, at 0.14%. And if you want to take a look at the largest holdings, as we said, Prologis REIT the one that we did review today, makes up a significant amount at 8.2%. We have reviewed Equinix as well, in fact, just in yesterday's episode. In fact, we have reviewed every single one of these REITs that you see on screen. Notable mentions, in fact, to today's episode that we didn't run through were essentially Extra Space Storage, which had double-digit upside as well, around 10 to 12%. And in fact, also PSA, Public Storage REIT, which had a very similar upside. But as always, we can't talk about every single REIT that there is out there. As always, let me know your thoughts, whether or not you prefer picking individual stocks or REITs, whether you prefer looking at ETFs, and if there are any other ETFs that you specifically like. On a previous episode, we did also briefly run through VNQ, which is the Vanguard equivalent to this ETF, although the holdings are slightly different. As always, if you enjoyed the episode, smash that like button, hit that subscribe and bell button, and as always, we'll see each and every one of you on the next one.